So option is a derivative product, right? uh, People just say this easily, and they don't come to realize the importance of this, and this whole option definition itself is so much of a complex thing that to decode this
Yes,
itself,
reply.
takes 1 month. And that's what happened to me when I started with option. I read this definition in the, most of the manuals, most of the books, and I slept off. So I will not go with this definition, with you guys, but I would like to show this to you, and then we will go with our own definition. Okay. So it says the right, not the obligation. Okay, to buy or sell an asset at a fixed price before predetermined date, and we will look at each component, in a live manner. So we will try to take an example. We are doing a paper trade, right? We are just we are not having any physical delivery with us. We are trading on a open market. But actually, how it happens with physical delivery, I'll try to explain that. So guys, there are two parties. Okay, party one does a market research, and he thinks that the onion price will go up. Now you'll think, why onion? See, anything which is commodity, anything which is an asset, we just we can take and group them into an asset class. Okay, so here I'm just taking a simple example because I like onion, so I'm just putting this as an example. Onion price is supposed to go up due to supply chain disruption. That's what party one has done the market research on, and as per them, that in 3 months time, onion price will rise, and current market price right now is 40 rupees per kg. So that these are the things the party one has done the market assessment, and he doesn't want to spend by taking quintals of onions right now and stack it in the warehouse and wait for 3 months. He doesn't want to do that. He says my capital is more important. I don't want to tie up my capital amount. And party two, which is probably maybe a farmer, maybe a wholesale market dealer, or somebody. He is like, current market price is 40 rupees, and he is getting onions maybe 5 rupees per kg, and he wants to maintain an average profit of 15 rupees. So he doesn't want to go beyond 20 rupees. His expectation is that he is not into trading. He is a very focused mind guy, and he just wants to make sure that if the in next coming months, the because of the volatility, maybe onion price will drop, maybe it will become 5 rupees, maybe it will become 10 rupees. So he doesn't want, he's afraid of that volatility. He's afraid of downside. He's not afraid of, he's not afraid, or he's not speculating about the upside. He's just wants to maintain an average profit of 15 rupees. So his mind is clear in that sense. So he's just trying to make his business more stable for the next coming 3 months. So that's what his mindset is. Then we would like to first understand what party one is doing and what party two is doing. Party one is speculating that the price of onion will go up, and party two is trying to curve down its downside. It doesn't want to sell onions at 10 rupees. It doesn't want to sell onions less than 20 rupees. So he wants to hedge his price. So that's what is party two trying to do. Okay, party two is more into hedging. Party one is into speculating. Okay, so some assumptions I have taken, that party one is interested to take 10,000 kg. It's time for expiration. So party one is trying to make a contract with party two. Okay, so party one has identified through market that party two is willing to give, is willing to make this contract with him. So he's trying to establish a contract, and in contract there are three things: price, quantity, quality. So in terms of quantity, 10,000 kg he has fixed with party two. In terms of the quality also, he has set the ground rules, probably because it's a physical good. So he said there will be an auditor coming and checking the onions quality. Time is taking 3 months. He'll say that I'll take around 3 months to make this commitment. And as an to whenever a contract like this is made, the party two is not interested in or in this kinds of contract until and unless he is getting something from him. So he's saying, party one is saying to party two that I'm ready to give you an upfront money of 80,000 rupees, and that is, non-refundable. So party two is, happy with that, and he's like, okay, this is non-refundable amount, and I'll get it. So actual price of the 10,000 kg at current market price, which is 40 rupees, is coming to 4 lakhs. But party one has paid an upfront amount 80,000, and it will use this in case. Let's see what happens. So there can be three scenarios. So in three scenarios, in first, let's say the price goes up, onion price goes up as party one predicted, and onion price reaches 80 rupees per kg. So the total profit that party one makes is 3,20,000. The return on investment is huge, 300%. So from 80,000 rupees, he made a profit of 3,20,000. Now, if you want to calculate, you can calculate later. But how it happened was, the current market price was 40 rupees. It went to 80 rupees. Okay, and if you see, with this amount only 40 to 80, he has made 4 lakhs. But since he paid 80,000, so the profit is actually 3,20,000. Right. So in this case, sorry. So in this case, when the price goes up, buyer exercises his the contract, and he gains a profit of 3,20,000. And seller is also happy. He's like, okay, I got there was nothing bad happening. So, but still, I took that hedging, and I was safe. But this is like, seller is, we are not taking the seller side right now. We are just taking the buyer side now. So party one is basically the buyer, and party two is the seller, right? I was using the words here, party one, party two, only because I didn't want it to confuse you guys. So now party one is actually buyer, and party two is seller. So that's how we treat in options. One is seller and one is buyer, and we are always on the buyer side. And in second scenario, price goes down. Onion price went to 20 rupees per kg. So in that case, this buyer will not, exercise his contract, and he will just say, okay, I don't take the, quantity. I gave the 80,000. That's my maximum loss, but I'm not taking the this thing from you. So seller will also like will say, okay, 20 rupees. I got 80,000. I'm happy. Still, I'm maintaining 15 rupees profit. He's not selling the onion 10,000 kg directly to this. He can sell it to anybody else in the market. Anybody in the market at the end of 3 months will take 20 rupees, per kg from the seller, right? But if the buyer takes it, he will be in loss, right? So he doesn't exercise his right. He will be in a huge loss. He will probably take. He had asked for 40 CMP that time, so he'll get a loss of 2 lakh. So he's like, I'm not ready. I was thinking it will go up, but since 80,000 was my commitment, that is gone, right? So this will happen when the price goes down, and if the price remains same at 40 rupees, then also buyer will not exercise. He'll say, okay, I'm taking a loss of 80,000, and I will, I'll not buy, because in that case, also there is no profit and gain for buyer. So buyer will say, why to buy that, physical good. So these are the three scenarios, and buyers will only exercise right of buying that onion from him in case the price goes up, right? So this is what is actually happening in our market also. We as a buyer, we are only interested when the market is moving in our direction. And if you see why we have to be buyer, we are actually losing. Out of three scenarios, we are losing two scenarios, and we are only winning in one scenario. So why you need to be buyer? So that's what is very important here. I'm getting a message, just a moment. So from guys, I'm not explaining stop loss here. I'm just right now trying to explain you the concept. Okay, we'll not get into the stop loss side right now. We are just trying to understand first what is this contract happening. Why why are you trading guys option? Why are you getting it for such cheap rates? You have need to understand that uh, options were not made for you guys, but it is now available. It's a thing that uh, trading has become in such a fashion that even options are getting traded. Earlier, options were used as a hedging tool only. Only if you were interested to take a physical delivery of a good. Anything like it can be coal, it can be oil, it can be grains. You need to take physical delivery. Here we are not taking any physical delivery of the goods. We are just doing paper trades. So you need to understand this. That these concepts of buying and selling in terms of options. So I'm just trying to explain you that concept. So that when you understand this, probably that mindset comes that who is actually trading here, right? They are big commodity houses. So that's what in this slide I wanted to explain you guys. So guys, just the supply chain is huge. When a physical good is moving, it's a huge supply chain. It goes from farmer to go down to manufacturer to commodity houses to distribution centers, retailers, and then customers. So it's a big supply chain, right? Now, now you see how many buy sell sides are there, right? Farmer is selling to go down is selling to manufacturer, manufacturing selling to commodity houses, and these commodity houses they are playing the main game. Commodity houses in the market, there are, you will not even come to know their names. There are names like Trafigura, Cargill, for small commodity houses. They are all playing this hedging game. Why? Because they have got physical goods in their warehouses, in their distribution center, and they are hedging through options. So while you are just doing paper trade, actual business is happening there. So you need to understand that there is different mindset happening in the market, and this is the crux of option. There is a contract between a buyer and seller, in which buyer has the right to buy. See, in first case only buyer exercised his buying. Okay. In the other two scenarios, he didn't exercise his buying. So he has the right to buy, but he is not obliged. And seller has an obligation to sell an asset. Seller, if that's the reason we said never become a seller, because if you are a seller and you are obliged by the buyer to give at that price, right? So only if you have a physical delivery of something in your portfolio, then only you become a seller. Or you become a seller if you know what is happening exactly in the market, right? There are so many dynamics in the market. With there's such a short linear supply chain. It can be a more complex spider web supply chain where farmer is coming and giving it to distribution center, or commodity houses are directly taking from farmers and going to customers. So it can be so many scenarios. It can be a whole spider web here. This is, I'm just selling in a very simple format of linear supply chain. So actual market, buyers have the right but not the obligation. Seller are obliged to sell an asset when a buyer is coming to him, right? Here the asset was onions. That's also known as underlying asset. And if Nifty, like we are trading Nifty is the underlying asset, and Nifty option prices that you're seeing, seven different strike prices, those are options, right? 80,000, which here the party one gave to party two as an upfront amount, is the premium. Okay. And 80,000 is something which is non-refundable. So after the 3 months period, it is non-refundable. It is gone, is gone. So that is the expiry date, 3 months, right? So you understand right now there are key factors here in an option. People were asking what's the difference between futures and option. Future doesn't have all these time decay things and all. It is just whatever Nifty is doing, that's what Nifty future will be doing, right? But options will be behaving a lot different because a lot many complex supply chain is behind it, and you don't want to mess with these variables. So if you are learning options right now is basically what we are doing, we are trying to manage the risk also at the same time in the option. So option is not a very easy game. It looks easy when the call goes in our side, but it's a very complex game where so many factors are affecting the option premium. It gets affected by the volatility. It gets affected by the how many people are making the contracts. What is the open interest? Open interest. It gets affected by the time. It gets affected by the underlying asset. How it is falling. So there are so many factors, and I don't think so. If you are doing a intraday, so many factors you can look into it, right? Even if you're looking into it, then you can just keep looking at it. So just don't buy options based on your perception. Try to see what the market is actually telling you, and when market is really choppy, you need to make sure that you're doing the trades in a very disciplined manner. Don't get into emotional trades here and there. Can I buy this? Can I buy that? Because so many variables are affecting it. You can't just guess all these things in a matter of 5-10 minutes. When we are giving calls, we are actually looking back into last 1 week what happened, last 3 weeks what happened. We are looking back and then assessing the present day. Why? Because we have been trained like that. We have our eyes have got trained, our minds have got trained. So it takes a time to actually know everything and start giving your own advices to other people. So I'll say that when you're doing the day trade with us, stick to the principles, stick to the stop losses, entries, exits, and don't take any advices that is coming from different people, because it's not as straightforward as it looks. That's what my point is. There are so many mindsets here, so many trading strategies are happening. You can't just say that I am the best trader here. Why? Because there are lot many other traders applying some other principles based on other concepts, because so many features are there. So in that same trade, even option seller can be profitable, option buyer can be profitable. It's how you apply it, right? So I have three questions, and I want you guys to do your own this research based on this session. Okay, normally questions you will be asking me, but also I also will be asking you, so that I can assess you who is trying to get the market right. So why did buyers enter into this contract? The party one entered this contract where he lost 2 out of 3 times. I've said this before also, but why did he entered in this contract? And I also want you to look at it, why seller came into this trade. Okay, and why it is always said never sell a naked option. So these three questions, I want you to make your own research, share that research with us, and then probably we'll give this answer sometime later when we have received answers from you guys. And I think that's it from my side. I'll just stop the presentation. I'll start taking questions now.